welcome to Business Television India. I'm Fatima Mahdi and you're watching Financial Planner. Joining me today is Feroze Azeez, Deputy CEO at AnandRathi Private Wealth Management. Feroze, always such a pleasure to be speaking to you. Thank you for this conversation that we're going to be having today. Today I would like for us to focus a little bit on debt funds. What are your thoughts when it comes to debt funds, and what are some of the trends that we're observing lately?
See, when it comes to debt, firstly, debt as an Indian asset class, it's something which is very well preferred. So point one, debt is going to be an integral part of one's portfolio, especially when you look at how Indian HNIs and the mass affluents as well have allocated their money. Debt has formed a large component of it, especially when you compare it to the financial assets which they end up buying as against the physical assets. That's point one. So point two, the best vehicle to participate in debt is a debt fund for 2-3 reasons. One is, of course, the tax efficiency, which the fixed deposits don't bring on the table. So if debt mutual funds, like your question is on debt mutual funds, so it's so important that we understand the nitty-gritty of debt mutual funds. If you're an investor, it's very important to understand the key attributes and elements in your debt strategy. So point three is when you buy a debt fund, you have to understand what are the risks you're taking. There are two risks prominently which surface time and again when it comes to debt funds. One is called the credit risk, where there are companies which don't pay back in time or don't pay back at all. That's called the credit risk. The other risk, which people generally ignore, is the interest rate risk. The prices of the debt funds move inversely related to the interest rate in the economy. So that's called the interest rate risk, which if higher the interest rate, the less the money you will end up making if the interest rate shoot up, and vice versa. So that's called the interest rate risk. So coming back to your question, Fatima, what's the trend we are seeing? The trend, of course, on the credit risk has been the contemporary topic every day, where companies, some AAA rated companies, have defaulted on their payments. So that's creating a huge fear, and the bigger fear as an advisor which I have and which keeps me awake in the night is because investors derive wrong conclusions out of episodes. During times of credit risk defaults, people end up deriving wrong conclusions. So that's what they shouldn't, and learn from the mistake, the right learning, and implement that for future investment strategies.
So you've really hit the nail on its head, because I understand that debt, of course, is an integral part of client portfolios. And given your depth of understanding, tell me a little bit about these conclusions that investors have made, perhaps where there needs to be a better better understanding of how things work. Let's talk about some of the examples that you've been thinking about lately.
Correct. So point one is, as an advisor or an investor myself, I derive the first conclusion that the carnage today in the debt market is resulting from AAA rated companies defaulting, not the tiny A-rated companies or AA rated companies. The problem has blown out of proportion because they were AAA rated companies. So conclusion to be derived is rating cannot be your only method or measurement of risk, point one. The second conclusion or the learning from this episode is, when you buy AAA rated mutual funds, it is clear that the amount of money invested in these AAA rated companies is not 1-2%. There are funds with exposures of 10, 15, 20% because they were AAA. Second is, the concentration risk on AAA rated funds is enormously more than a credit risk fund. The third thing which you have to derive a learning is that when you buy a AAA rated fund, you will have to check how many total issuers do you have. There are about 38-40 AAA rated group companies which are there in this country. You may buy 10 different funds, but those 10 different funds are going to be converging it back to a small universe. So the net, I'm deriving this conclusion that AAA rated funds in certain pockets of time could be far more riskier than a credit risk fund, and that's what this episode has proved. And people should not go with this conventional mindset that credit risk funds are going to be more riskier than AAA rated funds.
Feroze, thank you for that explanation. The recommendation that AnandRathi has is about revolves around a particular type of accrual fund and looking at really delivering sustainable returns, right? So tell me a little bit more about how you're looking at this and also the kind of recommendations that you have. I understand there are 7 debt funds that are being recommended by AnandRathi. If you could just sort of flesh out how that selection has taken place, what are the kind of criteria that you've used when you've looked at these particular entities? Tell us a little bit more about that.
Great. So firstly, for the last 6-7 years, the wealth management outfit, AnandRathi as a wealth management outfit, has not recommended AAA rated funds at all. And we have recommended 2 kinds of funds, which is accrual funds and credit risk funds. This has been a conscious strategy on the debt side, precisely for the episode which happened last year. Today we might see merit in the argument, but this has been our stance for the last 6-7 years. Point 1. Point 2. What are the funds? What is the criteria of choosing those funds? And should you buy 1, 2, or all the 6-7 which is recommended? Is the next important question. One is, you should, when you buy debt funds, you should spread your money as thinly as possible. Because all eggs not be kept in one basket is most relevant with debt, not with equity. So spread your money thin becomes a key element of your debt strategy. Don't concentrate your money, because defaults can be very hugely denting and it can have a very large setback to your portfolio. So having said which, point 1 I'm making is, when you take a recommendation of debt funds, take all of them. Like the 6 funds which we recommend, you have to combine all of them in equal proportions to get a very, very robust portfolio which can isolate you from massive shocks and give you some degree of cushion. Now coming to the selection criteria, Fatima, when you combine a portfolio like the ones which I'm going to mention, those schemes, if you combine them, you will have 152 companies you have lent to. So the first criteria is diversification. Diversification, by which I mean you're spreading your 100 rupees into 152 different companies if you buy these 6 funds which are advised. So that makes it a very thinly spread portfolio. Point 2 is, you have to check the asset management company's pedigree of correctly choosing the right companies which don't default. That's the second criteria. The third criteria, very importantly, is what is the interest rate risk which the portfolio takes. Accrual funds and credit risk funds have a lower interest rate risk. So the interest rate risk is expressed, if I have to make it simple, it is maybe 50% lesser than a AAA rated fund. So first criteria is diversification. Second criteria is the asset management company's pedigree of choosing bonds which have not defaulted in the past, and even if they have defaulted, they have had collateral to back that lending. And the third is, of course, the interest rate risk. The fourth, most important, is what is the kind of return I'm making. Now this portfolio which comprises of 6 debt funds has a return expectation which is called yield to maturity is 9%. AAA is at 7, this portfolio is at 9. That means you're getting 2% more than AAA. In case 1 or 2 bonds default, you still have a headroom of a default, because you're anyways getting 2% more for the next 3 years, 4 years, and you get 8-10% as your net provision for NPAs. So that's one. In return, diversification, asset management company, interest rate risk, all these are very, very important criteria to create a portfolio, and that's what we use. And all we recommend is, when you take a 6 fund portfolio and put your money in all of them and not in 2 of those 6 which have been spoken about.
Feroze, just while we're talking about this in a bit of depth, could you just throw some light on fund examples? I want to start with the DSP, the credit risk fund. Tell me a little bit more about what sort of going in there. What are the recommendations you have, perhaps, for someone for obviously investors who are somewhat nervous about what's been happening? What is the timeline in terms of any potential exit? Let's just start with that. Tell me a little bit more about this, please.
See, firstly, let me read out the recommended funds. then I'll go to those funds which have had the biggest accidents in this journey over the last 6 months. So the 6 funds recommended ones are Franklin India Credit Risk Fund, ICICI Prudential Credit Risk Fund, Reliance Credit Risk Fund, UTI Credit Risk Fund, Axis Credit Risk Fund, Kotak Credit Risk Fund, and to add one more on the Franklin basket, Franklin India Dynamic Accrual Fund. So these could be the 7 funds. All of them are, like you would have heard, Fatima, they are all credit risk funds. The conventional mind of the herd mentality is going to tell you, your subconscious mind, that you should not be buying credit risk. But if credit risk are those funds which analyze credit risk far more than a AAA rated fund, they have collateral in certain cases as well, and the fund manager spends immense amount of research to buy companies, and most of the issuers or most of the companies you wouldn't have lent more than 1.5% of your money. So that's the reason why I would believe this portfolio could be sometimes safer than a 6 fund AAA rated portfolio as well. So that's the recommendation. Then going to your most obvious question, which is which are the fund examples where you can have a maximum learning, and if you're fortunate to not have your money in the ones which I'm going to touch upon, then we are lucky, but you can still learn from somebody else's mistake. One of the funds which has had the maximum fall in the NAV because of its exposure on 3 companies is DSP Credit Risk Fund. It had exposure to ILNFS, DHFL and Syntex, BAPL. All the 3 have had a markdown. Like DHFL has been marked down by 75%. So this has had a very, very large dent on the NAV. So that's one fund. It had an exposure to ILNFS, which was a AAA rated company, but on September 3rd, if I'm not wrong, was downgraded. So almost 445 crores of this fund is been invested in ILNFS, and that's in trouble. And DHFL also has been marked down by 75%, and that's why I would say DSP in turn has had a large dent, because these 2 defaults were AAA rated companies. We have had instances in the past, like JSPL was an instance where Franklin Templeton had an exposure, but it was not a AAA rated company. In fact, it was not even a AA rated company. That's why it didn't become a national news, because the exposure each fund had was minuscule, and that was very easy for the investors to absorb. So that's the first fund, Fatima.
Feroze, just very quickly, I was just taking a look at the Invesco India Credit Risk Fund, the workings of it again. They seem to have had a concentrated portfolio, about 15 issuers, where top 5 holding companies comprise almost 50%. What do you say about this kind of strategy when it comes to a credit risk fund? And that's quite a concentrated portfolio that we're looking at. We're also looking at a situation where we've seen 2 defaults. You know, what's going on there? And clearly, of course, not advisable for any kind of fresh investment to be made in this. But just tell us a little bit more as, you know, a learning in terms of how investors can look at, you know, what to do and what not to do, and what to look out for really when they're putting their money in.
See, like we spoke, Fatima, let me reiterate this so that it's loud and clear to each viewer, that in the debt side, diversification is the most important job you have, or your advisor, or you jointly have. Buying a credit risk fund with 15 issuers is a non-starter in itself. So if you've bought it, you have to exit it. Point 2, we should never do this mistake again of buying concentrated credit risk funds or AAA rated funds for that matter. Like you said, Fatima, Invesco had ILNFS and Syntex Industries. Both of them have had markdowns, and that has created a huge dent on the NAV because of its concentration impacting itself. And now ILNFS is subject to sub judice the matter, and then if there is recoveries happening, that will be good news for existing investors. Like you rightly pointed out, no new investor should be buying this fund for sure. There is a lot of curiosity in investors' mind saying that the NAV has dropped sharply. Why don't I buy it at this price? But I would recommend against that, because the fall in the NAV sometimes. See, DHFL Pramerica Medium Term Fund has created history with the kind of NAV fall on the debt it has seen. For the reason of its exposure, concentrated exposure in the DHFL paper itself. So the fund ended up having 67% exposure because there will be a lot of outflow from the fund in a situation like this. So the bond which is residual in the portfolio keeps increasing because investors who redeem keep taking out those, the fund manager sells the good bonds and gives the money back. So people who stayed back currently have an exposure of 67% of the fund is in DHFL, and that's created a markdown of 53% on June 4th for this fund, which I don't think Indian mutual fund industry has ever seen a markdown of that nature. And so these are stories which should define our investment strategy in the future. Unfortunately, we forget these and don't write down our principles of investing. So concentration is something which is so bad for a debt portfolio, which each investor has to know. Now, when you meet the most sophisticated clients and ask them this question, that how many bonds are there in your mutual fund portfolio, they say, I don't know. Now, that's not a good thing. If you have extra money and you're investing it, you're duty bound to go to the nitty-gritty, or at least your advisor needs to know how many bonds are actually there, unique bonds in your bond portfolio or your mutual fund portfolio. Like we just discussed, if you bought these 6-7 funds, you will have 152 to 157 companies. Knowing how many are there, which are the top 10 companies you have lent to indirectly through a mutual fund platform is also your duty. And I think the more aware you get in the journey of investing, because that's going to be a 20, 30, 40-year journey. So it's always good to learn it in the first 4-5 years and draw up a good path for your accidents in the future to be minimal. So I'm trying to use this opportunity on the DHFL Premica Medium Term Fund to again reiterate that people should know the underlying debt and not just the fund names, which is what people end up knowing, and they don't look through transparently inside the fund to check what is there and what kind of concentration does it risk or does it run for you.
Feroze, thank you for that. I'm going to ask us to just hold that thought for a few moments. We're taking a short break and coming right back. Welcome back to this edition of Financial Planner. So scratch definitely much more than on the surface, understand what to really look out for. Feroze, it's human nature for investors to hunt for higher returns, okay, and to look for this whole equation of risk in terms of the yield that they're craving. Let's put this in context when it comes to debt funds now. What are some of the, and I'm going back to the original conversation we had, which was about perception as well as knowledge when it comes down to it. So this whole idea of, extra risk, higher yield, what are some of these, how is that really working out on the ground here?
See, extra risk is for a person who does not have a clearly written down strategy. Risks are going to happen. We have to manage them. That's why it's called risk management. So management of risk is a easier task provided you know what's your aspiration of risk. So credit risk fund portfolio, like I just mentioned, to my mind is lower risk than buying 10 AAA rated portfolios, because those 10 AAA rated portfolios might concentrate it back into 30 companies. So please just don't go by the word risk, but go with the actual measurement of it. So you have to measure concentration risk, you have to measure collateral, you have to measure which are the fund managers, what is the kind of interest rate risk. People use risk as a word very loosely without actually getting into the depth of it, and which risk are you wanting to mitigate, what are the types of risk. If you ask the most sophisticated investor, I met somebody who had 45 crores in debt funds, and he says, I want to reduce my risk, but he doesn't know which are the 3 risks he needs to reduce. So unless you write it down, you'd say that this should be my strategy to bring down risk. So at ground level, this is not happening. This should happen. If you're a mutual fund investor, you should know what are the risks you're taking and how to mitigate them. Every risk comes with a solution to mitigate. You have to go discover that solution with your advisor. If not your advisor, look at shows like these. Of course, BTVI has always had this save, invest and prosper. And I'm thinking you're living by that theme, which your entire work is revolving around. So I think electronic medium of communication is a good medium for a learning journey for an investor.
Feroze, it's always good for an investor to listen to you regardless of what we are discussing. Just a little bit from you in terms of the idea of liquidity and also term. Liquid funds, ultra short fund or short-term funds. What exactly, do they mean for investors? There's also perception that certain dynamics within funds make them risk-free, so to speak. Let's get into a little more knowledge sharing when it comes to that. So, can you explain a little bit about liquidity as well as term when it comes to investing in funds?
See, it's a very practical question, Fatima. Quite a few of us have liquidity which is not meant for investment but is meant for consumption, for a payment to a builder for the house you've bought. Whenever you have surplus funds, making them laze around in bank accounts might not be the best idea. So investing for momentary periods to manage the liquid assets which you have, which are not for long-term investing, of course a liquid fund becomes a very, very good method to invest, because liquid funds can park your money for 3 days, 5 days, 20 days or even a few months and give you a couple of hundred basis points more or 2% more than an FD on a post-tax basis, possibly, because FDs give you interest income, short-term debt funds give you, or liquid funds give you short-term capital gain, and short-term capital gain is easier, so it can set off against other short-term capital losses you might have had on the equity side. So point one I'm making is, it's a practical thing. Most of us in our lives will have extra money lazing around for a few months, few days. Your liquid fund is something which you all should learn. Point two, there is some degree of extra return to be made in the interim period. You can use that rather than a savings account. Point three is that when you get into a liquid fund, you need to understand one nomenclature which sounds more technical than it is, called a treasury bill. When you're buying a liquid fund, see the portion of the treasury bill. Higher the treasury bill papers, treasury bills which are there in the portfolio, the lesser the risk it is, because it's backed by RBI and the government in turn. So treasury bills are short-term papers with almost a sovereign guarantee. Like in the ILFS episode, there were liquid funds which had an ILFS exposure on the commercial paper side. So please buy 3-4 liquid funds. When you buy 3-4 liquid funds, you need to know what are treasury bills. Higher the extent of the treasury bill, the safer it is, and especially liquid funds are very well managed and very well regulated. That's the largest portion of the 2.5 trillion or 225 lakh crore is what we have in the mutual fund industry, and liquid funds are the largest contributor to this 25-26 lakh crore. So it's a very well regulated platform. So you don't have to worry too much, but yeah, it's always good to know what you've bought.
Feroze, it is always such a pleasure to have this conversation with you. Thank you so much for really throwing much more clarity when it comes to debt as well as debt funds. Always a pleasure to have you right here on Business Television India. That's a close on this edition of Financial Planner. News and updates always continue here on BTVI.